Peak ahead increased volatility seen as bullier equity market class continues. Hey YouTube, watch this video. Sampling stocks make valuations more attractive. Has inflation peaked? 10-year yield can act as a gauge for upcoming inflation. The recent financial market clash between bulls and bears is likely to continue and possibly escalate as spiking inflation and rising interest rates continue to dominate investor forecasts. An added dollop of geopolitics could also boost anxiety to red-hot levels. Nevertheless, with all four major U.S. indices, the S&P 500, Dow Jones, Nasdaq, and Russell 2000 finishing a volatile week in the red. The valuation of many previously worthy stocks could begin reaching price points that some may consider buying opportunities. Still, the primary market drivers will remain the level of hawkishness the Fed applies to upcoming hikes along with whether we've reached peak inflation, something that could become apparent via this week's CPI and PPI releases. The Producer Price Index gauges wholesale prices which eventually trickle down to consumers. Economists expect the reading to come in at 10.7% versus the 11.2% print seen in March. Some economists have already made calls regarding peaking inflation, with expectation for April's YoY Consumer Price Index print forecast to be slightly below March's 8.5%. Investors could then look the Treasury yield to judge the market's interpretation of the data. The burning question remains tough. Can the Federal Reserve actually slow the U.S. worst inflation in 4 decades? Last week, the Fed announced it had increased its Fed funds target rate by 50 basis points and signaled it would likely continue with additional hikes of similar magnitude. After the meeting, Fed Chair Jerome Powell added that he expects a soft or softish landing he attempts to infuse markets with confidence. The benchmark 10-year yield closes at 3.1 and 42% on Friday, at the very top of the session, the highest level for the much follower Treasury note since November 2018. An additional 1% elevation will take the 10-year yield to hike not seen since 2011. Yield rise when bonds are sold off. Generally, investors do this when the appetite for risk becomes more prominent in order to rotate into stocks. However, the current context is a bit different, as risk sentiment remains highly depressed. Investors are selling bonds worth current buyout strings versus expected future yield. Yields have climbed for the fifth straight week or for 8 of the past 9 weeks. The weekly trading action blew out a hanging man last week. The 50-week MA is about to cross over the 200 WMA triggering a weekly golden cross for the first time since August 2017. Yield rose more than 1% after that. If on the other hand the price peaks out, it would provide more breathing room for the Fed. Thank you for watching. See you in the next video. Bye bye.